Good morning and welcome to the Gold, Goats, and Guns market review for Wednesday, July 25th, 2018. We don't really have a lot of preamble this morning because we're not doing any real housekeeping. So let's just get right to the situation as things are laying themselves out. All right, so European Commission President Jean-Claude Juncker is in Washington to discuss the situation between the United States and the EU on trade. And for those of you following this, and I'm sure you are, President Trump has declared an open trade war with just about everybody in the world because he doesn't like the way our international trade agreements are structured. He feels that they are anathema to American interests, and the European Union is the body I think he is most angry with. And I think he's most angry with the EU for a couple of different reasons, not just because of the quote-unquote trade imbalance, which I've explained before isn't as big a deal as Trump makes it out to be. But regardless, I think actually the bigger deal with the EU for Trump is that he doesn't like it. He doesn't like the EU any more than he likes the UN. He doesn't like the EU or the UN any more than he likes any other transnational treaty organization, NATO, or the rest of it, and feels very strongly, like a lot of libertarians, interestingly enough, even though Trump is no libertarian, that entangling alliances like this are dangerous and counterproductive and against everybody's best interest, including the people who are defending them. So the U.S.'s protection of Europe, for example, isn't doing Europe any favors in Trump's mind. And that's part of why he's attacking them so hard. I think that's why he's been so adamant about changing the Iran nuclear deal. I think it really does have to do with him targeting Germany and targeting the EU in particular in order to either break it up, force it through pushing into a different geopolitical alignment and be more independent in its foreign policy. That's what I think is going on. I may be wrong, but I think that's the most nuanced read of what's going on with Trump. All right. And so he and Juncker are going to sit down. Juncker is a notorious drunk. I think he's also got health problems, probably has complications because he's a notorious drunk. So we'll see how these things go today. And remember that Trump does not drink, neither does Putin. And I'm sure he'll have very little sympathy for Juncker's position. So it should be interesting. And Juncker is one of the most evil men on the planet. And I hope Trump takes him to the woodshed just because. All right. Housing. Let's talk about housing real quick. There's the latest housing sales numbers came out this morning. Prices continue to rise and numbers continue to fall. And this is a very important leading indicator that we're seeing a lot of hot money flow into the United States, especially during that weak dollar period where foreign currencies would go farther in buying U.S. real estate, especially with China. A lot of Chinese buying up, farmland and residential property and whatnot. But the big markets here in the United States, the Seattles, the San Franciscos, the New Yorks, Miami, are all under serious pressure. And that's a leading indicator that we're going to get a rollover. But at the same time, I still believe that we're going to see even more capital flight into the United States, but I don't see that it's going to happen in those housing markets. I think we're going to start to finally see, or not even finally, we're starting to see a rotation away from those markets and into secondary and tertiary markets. And we're positioned to take advantage of that in the Gold, Goats, and Guns investment newsletter in our portfolio. And a couple of stocks that we have that should dovetail nicely on that trend. Something you want to continue to watch, which is especially as interest rates start to rise, that means that sales are going to taper off. Prices paid are going to start to taper off, and then they're going to roll over. It may still take a year. Don't get me wrong. I'm not talking about like housing is going to crash tomorrow and we're going to have another 2008. That's not what I'm saying. I'm saying that the trend is in place the end of the cycle is approaching, and probably right on time for a European sovereign debt crisis, and which will extend that cycle another say 9 to 12, maybe 15 months, but then it'll roll over. All right. Amidst all of this, gold is holding up relatively well. I'm surprised, actually. Trump has tried to jawbone down the dollar and take the Fed to task for raising interest rates, but the truth of the matter is that got to raise interest rates or we're going to have a pension crisis in this country. So, and if you really want to bring people to heel over tariffs and everything else, well, then a stronger dollar will frighten them to death to get to keep trade lines open, because it's the only way they're going to be able to. Foreign corporates are going to be able to service their dollar-denominated debt, right? And we're seeing this. We talked about this on Sunday's market update with China. Okay, now we're dealing with Japan, and there was a media report on Monday that the Bank of Japan, the BOJ, was going to start allowing interest rates to rise. I read a great article on Zero Hedge this morning from cribbing a couple of different analysts' take on this, and it comes down to a very simple situation. The market wants the Bank of Japan to allow Japanese interest rates to rise. They refuse to do so. I'm going to show you the chart of the Japanese 10-year in a couple of minutes, giving you an idea of what's actually happening. Okay, and why the BOJ is completely trapped, and that predictions that were made in 2015, and I'll put a link to this article on Zero Hedge in the description of this video for you guys to review. But predictions made by IMF and other economists in 2015 saying that the Bank of Japan would own by the end of 2018 more than 50, if not 60% of the entire Japanese government bond market, effectively saying that between that and Japanese pensions and corporates, it being effectively a closed market for JGBs, there is no market. And at some point, the whole thing becomes incredibly fragile. One small shock, and the whole system could collapse. The whole bond market in Japan could collapse because there would be no bids. And the BOJ announced unlimited buying in response to that report, and there were no takers. And that should scare you. When there's no takers for Japanese government, for someone's sovereign debt, that's never a good sign. That's always a sign that there's actually no market. It's the same situation with Italy, right? The only buyer truly of Italian debt at this point, sovereign debt at this point, is the European Central Bank. All right, so these are the things that are leading to a spasm and a collapse across the board of sovereign debt. And this is going to feed into a further populist wave that will see the definitions of risk assets change from stocks to bonds. Stocks will become risk-off assets. They will become safe haven assets like gold. And in the short term, all U.S. assets will be considered safe haven assets. They will get a bid simply because so many of the assets around the world are priced in dollars and have to be priced in dollars because of the way they've been hedged and the way the risk has been laid off and all that other stuff. Okay, so that's the problem at this point. And when this one fails, it's going to be bigger than the central banks. All right, let's get to the charts and I'll get you out of here. So I think we may be having a bottom form in gold. I'm not convinced of it yet, obviously. But I told you on Sunday that I thought last week's close was encouraging because of this nice long tail. Now we've had follow through this week. We've had follow through action, a weak move up in gold, but still nothing, I would say, concrete. Would like to see a close this week at least above this point here at around 1236 or so, which was previous support. That would help. But it's not really strong. This support level's been destroyed, but at least we need to start there. But really, gold needs 1243.80, which is last week's high. Gold needs to tell the market that a 1-bar reversal signal on the weekly chart is its definitive statement that that's a bottom that we formed the other day at around 1210 or 1208, whatever it was, and that that this whole long downtrend here is over. This is our big liquidity washout on a rising dollar, and then we're going to start to see higher gold prices. I may be wrong about that, but this is what's happening, and I believe that this is the beginning of that. And then I'm going to show you the chart of Bitcoin in a minute, and I think that helps to confirm what I'm seeing. But let's look at the Japanese government bond market, as I was telling you previously. So talking about it earlier. All right, so this was the media report. We had a huge spike because remember, the BOJ has been doing yield curve targeting, right? Their form of QE is to buy all across the yield curve in order to from 1 month all the way out to 50 years, and buying them in such a way as to manipulate the yield curve so that there's a slowly rising yield curve like it's supposed to be, like a normal healthy yield curve in a normal market. They're just now faking it by buying to support prices. It means that they're exploding their balance sheet. It's now more than 20% of Japanese GDP. It's insane. Okay. Then again, so is the Feds, right? It's around it's about 22. The Feds is around 22% of U.S. GDP. So it's only going to get worse from here. Because they're not going to continue. They're not going to stop this process. They can't stop this process. They can't stop what they're doing. All they can do is to continue to do what they're doing. They've been pot committed to this QE strategy since the 90s. It's the wrong strategy, but they can make it work because of the way Japanese culture is and the way the Japanese markets work. All right. But only because the rest of the world goes along with it. At some point, once the crisis hits, the whole world is going to call bullshit on all of it, and it's all just going to collapse. All right, so we had that media report, then the BOJ intervened, and we've seen this move down, but they still can't get it back in the box, which is back down here. Okay? And that should tell you, that should worry you, because this is putting pressure on the yen, which it should. And the yen is still too strong. It's putting upward pressure on the yen, so... And they can't afford any of that. It's not the right policy. Remember, this is not my preferred state of affairs, right? My preferred state of affairs is that the central banks go away. But that's not the case right now. The case right now is that this is what we're dealing with. So, all right. This kind of insanity is what we're dealing with. We're going to watch this. If we see a move above 0.1% on the Japanese 10-year, that should be very significant. There will be a coordinated and massive response from the central banks to keep that from getting out of control, in the same way that there was a coordinated effort to keep the U.S. 10-year from breaking and closing that week above 3.05%, which was also an important technical level. That was happening during the Russian extreme dumping of their treasury bonds back in early April, which I know I've written multiple blog posts about. All right, the last thing, let's talk about Bitcoin. So on Sunday, we were talking about how it was encouraging that it looked like we had gotten this 1 bar reversal here. Last week, we had the breakout above 7,000. Last Wednesday, that was encouraging. Then we got the follow-through action, which gave us a close. Now we're getting a further rally this week. So that's very, very strong. And again, if Bitcoin is another proxy for gold, then if Bitcoin's putting in a bottom here and gold is putting in a bottom here, then that may be... Those two together may be signals that we're approaching the end of the dollar. This move out of safe haven assets, this move out of tangible assets, just to raise dollars in order to deal with tightening liquidity. And now people are starting to think in terms of safe haven. Right? It's because the problem with these markets, especially the ones that lie at the intersection of government intervention and the people's perception of what's happening, right? And hard assets like Bitcoin and gold and commodities and others lie at that intersection. And what it means is that they will move in different directions for different reasons at different phases of the cycle. So no one analytic tool set works for them all the time. You have to stay nimble in understanding them. And this is frankly why you guys listen to me, because I'm one of the very few people on this planet who will actually do this kind of multivariate analysis on these markets. Now, I can't do multivariate analysis on all the other markets that exist, but I know these markets well. And so if you know where you're going, then you can start to see these inflection points in markets and see the changes in sentiment and how they relate cross-market with other things. And that's what I think is happening in Bitcoin and gold. I may be wrong, but it's something that you should be aware of now. Because if you decide to toe dip back into Bitcoin, here you have your upcoming resistance levels, 75, 78.60, 10,000, right? So if you wanted to take a trade in Bitcoin right now, you get about $500 to the upside before real resistance, possibly as much as $1,500 or $1,700. Go for it. But I'm also talking about the larger trend here, because if that sentiment changes the case, then once Bitcoin really starts to take off, then all the altcoins we'll get back into last year's rotation trade, where Bitcoin will surge to $3,000, and then there will be some profit taking that'll move into the other cryptos, because people won't want to leave the crypto space, right? They're going to want to keep those profits in the crypto space in order to avoid taxation and avoid a variety of other things as well. And that's when you'll start to see, good projects that are languishing, down 75, 80, 90%, they'll start to break out and move 20, 30, 40% higher, because all of a sudden billions of dollars will rotate out of Bitcoin into these markets that are tens of millions of dollars, and all of a sudden they'll be hundreds of millions of dollars again, and then we'll move forward. All right. So that may be what we're setting up for second half of the year in the crypto markets, along with gold. All right. So these are the things to look for and consider as we go forward. So I'll update this narrative on Sunday. We'll do another one of these again, obviously, and we'll go from there. And we'll just try and keep you up to date as much as possible. The unfolding story in Japan, however, is something that I'm seriously considering adding into the narrative going forward for the next couple of newsletters, and something I'll have to spend some time thinking about over the next couple of days while I sit down to write next month's newsletter. Right now, the situation with Japan is always something that's been important to me, but it's been on the back burner until we finally got a discontinuous event like this one. All right, so that's pretty much what I've got for today. You guys take care. We'll talk soon. And always keep your stick firmly planted on the ice. Take care.